Welcome, everybody, and thank you for joining me for the presentation of the highlights of our second quarter 2024. My name is Guido Pickert, and I'm Vice President Investor Relations at Gerresheimer. I joined the company at the beginning of the year, and I'm very happy to be able to present the figures to you. Let me start by emphasizing some very important aspects of our business being recognized as a strategic partner of choice for the pharma and biotech industry. With our containment solutions, we bring the drug safely protected to the patient. Our drug delivery systems enable the drug to be safely administered. With our connected devices and digital solutions for therapy support, we help to improve the health outcome for patients worldwide. Our Q2 results underline the strategic strength of this broad portfolio, which ranges from standard products and systems to highly sophisticated customized solutions. The ability to meet our customers' needs to capitalize on global megatrends, to industrialize and to scale production globally is and will be a prerequisite for strong competitive positioning and a sustainable, profitable growth. This is why we are the strategic partner of choice for the pharma and biotech industry. And that's why we were able to secure these long-term contracts for which we are currently expanding our production capacities worldwide. A second strong advantage of our broad portfolio is often underestimated, its resilience. This is particularly important to keep in mind regarding our Q2 and 6 months results. Yes, we were affected by the destocking in the market, mainly in our vials business, in our primary packaging glass division, and this impacted our results. Will this slow down our growth in the mid and long term? No, it won't. We still believe destocking effects to be temporary, and we are getting the first signals from the market that the destocking begins to fade out. And we were able to offset this effect with a strong performance in our plastics and devices division, in medical devices such as inhalers, pens, and auto-injectors, but also in plastic drug containers, the latter being a much underestimated business, which I will come back to in a moment. This is what I mean when I say that our broad portfolio makes us resilient. It enables us to offset market fluctuations in a particular business area, and you can see this in our results. Our Q2 performance was in line with the previous year's results. We were able to compensate destocking effects in primary packaging glass with a continued good performance in plastics and devices, including a notable margin expansion by 200 basis points. The decrease in adjusted earnings per share is solely due to the dilutive effect of last year's capital increase, which we performed in April 2023. Yes, we plan to see better results, but the main reason for the low revenues is the destocking effect. The important message here is that the underlying growth momentum remains intact. While the destocking effects gradually decreasing and the ramp up of new lines and projects are kicking in, we expect a strong second half of 2024. We are on track for sustainable, profitable growth, and we confirm our guidance. Equally important is, in the first half 2024, we have continued to lay the foundation for strong value creation in the years ahead. A very important milestone of our growth path was the signing of the contract to acquire Bormioli Pharma. We have already shared our key priorities for 2024 in previous presentations. We will accelerate our sustainable, profitable growth by consistently increasing the share of high-value systems and solutions and medical devices for injectables, in particular for large molecule biologics in our product portfolio. We will execute on our ongoing growth projects and add global capacity for long-term contracts, including contracts for drug delivery devices such as pens, auto-injectors, and syringes for GLP-1 applications. We will further expand our product portfolio with highly innovative systems and solutions, including our own IP solutions, connected devices, and platform solutions for digital therapy support. In past presentations, we have given an update on our ongoing capacity expansion projects. Today, I want to shed some light on how we plan to expand our portfolio, and especially how we want to increase the share of high-value solutions in our plastics business. The basic principle of our Gerresheimer strategy is to combine a strong foundation business, solid growth, solid margins, strong cash generation, with growth drivers that generate over-proportional top and bottom line growth. This combination is key to ensuring consistent and sustainable profitable growth. The old Gerresheimer, before we initiated our Formula G strategy process, focused mainly on a commodity and pure volume business. By complementing our portfolio with new and innovative solutions, and by focusing on customer centricity and operational excellence, we have significantly strengthened our existing business and opened the door to new high-growth markets. We have done our homework and have built that strong foundation. We now profit from a resilient and strong base business, and this business grows very stable in a mid-single-digit range and delivers very solid margins and reliable cash flows. It includes, for example, bulk vials, bottles or cartridges, plastic containers, and selected medical devices. On top of that, we systematically identify drivers for overproportional growth, products and solutions which allow us to grow faster than the market overall and to expand our margins, because these solutions offer significant added value to our customers, our high-value solutions. Growth drivers are, for example, our ready-to-fill products, including our EasyFill Smart platform, dedicated solutions for sensitive biologics, high-value syringes, metal and especially tungsten-free for biologics, or silicon oil-free for ophthalmic applications. Our own IP solutions, like our autoinjector GX Inbeneo or our GX Sense Air on-body drug delivery device for large molecule biologics, and digital solutions like traceability or connected devices, which enable digital therapy support. The new Gerresheimer now has a solid foundation of base business bolstered with high-value solutions growth accelerators, and we are continuously expanding our high-value solutions offering. The planned acquisition of Bormioli Pharma is a perfect fit for this strategy, as it complements our portfolio, both in the base business as well as in the high-value solutions business. In our call right after the announcement of the planned acquisition, we talked about the complementary portfolio in both glass and plastics in general, and especially how this acquisition will form a molded glass powerhouse with a diversified portfolio for pharma cosmetics as well as for food and beverage. Today, I want to show you how this transaction will strengthen our pharma plastics business, marked here in yellow, and in particular, going to talk about the high-value plastics solutions. With this acquisition, we're taking a leap forward towards positioning ourselves as a systems and solutions provider for high-value solutions in both glass and plastic. Bormioli's portfolio, regional footprint, and customer base are highly complementary to Gerresheimer, and this is also clearly visible in our plastics business. We will significantly broaden our plastics portfolio and especially our containment solutions with this transaction. The combined portfolio will enable us to provide a broader range of solutions for pharma plastics and containment solutions, an even stronger one-stop shop for pharma customers. Bormioli's pharma plastics portfolio is also highly accretive to our high-value solutions offering, as it includes, for example, additional attractive own IP solutions. High-value solutions growth drivers with significant added value for customers are normally associated with containment solutions and drug delivery devices for injectables. But the plastics portfolio also offers high added value for our customers through system integration. For example, bottle closure solutions, resulting in a higher margin for Gerresheimer. Today, we already have a wide range of integrated plastic containment systems in our portfolio, a container plus closure, including own IP solutions. These are high-value solutions in plastics, a very attractive business. Bormioli's portfolio will allow us to significantly broaden our offering, including also accessories. Bormioli's closure options will enable us to create new systems through system integration, new high-value solutions, containment solution consisting of glass or plastic container and the respective closure. What is the added value for the customer of buying a complete system instead of a container and a closure separately? Customers will have just one source for the complete solution, one point of contact, one supply chain instead of two. They will buy a fully qualified system with ensured functionality and tested container closure integrity instead of having to make sure internally that the selected closure option fits the container. Customers can tap into our primary packaging plastics product database to speed up their time to market with extensive technical documentation for the integrated system, including the documentation for fully customized solutions. That means considerably less effort for internal testing and documentation and a smooth regulatory registration and approval process. This is why 1 and 1 equals more than 2. A fully integrated system consisting, for example, of a PET or glass bottle and a closure of choice then becomes a high-value solution. The same goes for all other drug containers with various closure options, from desiccant closures to tamper-evident closures, child-resistant or senior-friendly closures, or droppers, sprayers, or nebulizers. Expanding our portfolio with innovative products and high-value solutions will help us to accelerate our growth of the top and the bottom line. This will be visible midterm and drive our strong development in the future. The Bormioli acquisition is surely another important cornerstone for our mid and long-term growth strategy. Now let me take a closer look at our figures in Q2 2024. Let's dive into the analysis of the key financials for the second quarter 2024. Revenues grew from 500 million euros to 502 million euros. This leads us to an organic revenue growth of 0.7%. The impact from FX was almost neutral. Our Plastics and Devices division continued its devices-driven profitable growth in Q2 2024. Our primary packaging glass division developed in line with our expectations. Growth was muted due to the already known and anticipated temporary destocking effects. Adjusted EBITDA remains at prior year's level of 107 million euros. This leads us to an organic adjusted EBITDA growth of 0.8%. Organically adjusted EBITDA margin remains unchanged at 21.6%, and the impact of currency was minus 1 million euros. Adjusted EPS went from 1.30 euros to 1.24 euros. This leads us to an organic adjusted EPS decline of 3.1%, which is due to the dilutive effect of the capital increase of April 2023. More to this later. The impact of currency was minus 2 cents. Let's move on to the divisional development in Q2 2024. Plastics and Devices, P&D. Revenues grew from 265 million to 283 million euros. This leads us to an organic revenue growth of 6.7%. The organic growth was driven by strong contributions from the medical systems business. Especially the business with pens recorded a strong growth. The impact of currency was neutral. Adjusted EBITDA grew from 69 million euros to 79 million euros. FX contribution was also here almost neutral. This leads us to an organic adjusted EBITDA growth of 12.4%. Organically adjusted EBITDA margin increased from 26.3% by 140 basis points to 27.7% and was also driven by a better product mix. Now to primary packaging glass, PPG, revenues declined from 234 million euros to 218 million euros. This leads us to an organic revenue decline of 6.6%. The impact from currency was minus 1 million euros. The temporary destocking effect at our customers' level impacted our pharma glass business and was the reason for the revenue decline, unchanged from the development in the prior quarter. Adjusted EBITDA declined from 49 million euros to 39 million euros. The impact of currency was minus 1 million euros. This leads us to an organic adjusted EBITDA decline of 17.4%. Organically adjusted EBITDA margin decreased from 21.2% by 250 basis points to 18.7%. Now to Advanced Technologies GAT, revenues remained on prior year's level at 2 million euros. Adjusted EBITDA is literally unchanged on prior year's level of minus 3 million euros. During the second quarter, the interest in our Inbeneo auto-injector remained high. Various tests with biological drugs have successfully been completed. Advanced Technologies continues to work intensively on new innovative solutions in the field of digital health and drug delivery solutions. Now to the reconciliation of Q2 2024. This slide shows the reconciliation to the reported and the adjusted financials for the second quarter of 24. Revenues grew organically by 0.7% and adjusted EBITDA by 0.8% as discussed in all detail earlier. Let me briefly comment on our EBITDA adjustments, which amounted to 4.7 million euros in Q2 2024. The majority of this amount is related to restructuring of business divisions and the meaningful ramp-up of our new production sites in Mexico, North Macedonia, and the United States. Adjusted depreciation and amortization was almost on prior year's level. The adjustments of 9.1 million euros consists of amortization of fair value adjustments. Regarding income taxes, the adjusted tax rate in Q2 2024 was 24.5% compared to 23.8% in Q2 2023. Adjusted net income after non-controlling interest increased organically by 2.2% compared to Q2 2023. Adjusted EPS went, as said before, from 1.30 euros to 1.24 euros. This leads us to the adjusted EPS organic decline by 3.1%. The EPS figure for Q2 2023 was based on a 32.8 million shares outstanding, while the according figure for the calculation of the Q2 2024 EPS was based on 34.54 million shares outstanding, which increased due to the capital increase in April 2023. In a nutshell, net income increased whilst EPS declined due to the effect from named capital increase. Coming now to the cash flow development in the second quarter of 2024. The free cash flow developed as expected. The adjusted EBITDA remained unchanged compared to prior years, Q2 at 107 million euros. Looking at net working capital, we see a cash outflow of 50 million euros in Q2, which is more pronounced than last year's Q2 with a cash outflow of 21 million euros. Taking a look at the first half year in total, however, our net working capital related cash outflow is still 39 million euros better than last year's figure. For the second half of the year, like last year, we expect a positive cash contribution from the release of working capital that should more than compensate for the development in the first half of 2024. Regarding cash taxes, the outflow of 10 million euros is significantly lower compared to last year due to different timings of tax payments. Moving on now, how we utilize these funds. Net capex in Q2 2024 was almost on prior year's level as we continue to execute our investment program into highly attractive growth opportunities. As you know, our currently elevated net capex cash out is a consequence of very attractive and unique business opportunities. We are especially ramping up our capacity for medical devices, GLP-1 products, and biologics. Finally, let's turn to net financial debt as well as the adjusted EBITDA leverage. Net financial debt, according to credit agreements in force, stands now slightly above 1 billion euros and therefore 100 million euros above last year's level. With this, our adjusted EBITDA leverage slightly increased from 2.4 times to 2.5 times. Now let's spend some time on our outlook. This is what will strengthen our solid foundation, accelerate our growth, help us to expand our margins, and ultimately enable us to reach our ambitious goals. Now to our guidance. We expect a significant upturn in the second half of 2024, and especially in the fourth quarter as new production lines ramp up and destocking effects fade out. We once again confirm our guidance. This includes our 2024 and 2025 outlook, as well as our midterm guidance. In 2024, we expect revenue growth of 5 to 10%. As we are still expecting some destocking effects in the market, we estimate revenue growth to be around the low end of our just named guidance range. The adjusted EBITDA, though, will once again be strong and reach between 430 and 450 million euros, in line with our plans for further margin expansion. The adjusted EPS is expected to grow between 8 and 12%. We also confirm our guidance for 2025 and our midterm outlook guidance. As you can see, we are on track and stay on track on our profitable growth path. Would be delighted if you would accompany us going forward. The next opportunity to check on our financial performance in 2024 will be our Q3 results for our fiscal year 2024, which we will publish on the 10th of October. And additionally, we are planning a Capital Markets Day this year again in December. We will keep you informed on the exact date. I hope you will join us again. Thank you and bye-bye.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.